everybody, and welcome to HardAssetsInvestor.com. I'm Mike Norman, your host. Today we will be looking at the currency markets with my guest, Marc Chandler, who's the Chief Currency Strategist at Brothers Harriman. Marc, thanks for coming back on the show.
Thanks, always a pleasure.
I want to talk about the outlook right now. We've seen currencies really kind of go into a much narrower trading range, sort of like volatility coming down. Do you see that persisting for any length of time, or can we expand? And by the way, it comes despite recent QE3 announcement, and every time that happens, we hear people get very bearish on the dollar. But yeah, we've had a very tight range in a lot of these currencies, and some of that post QE3 reaction has come back now.
Yeah, it's amazing. The Brazilians are the ones who cry loudest about having currency worries, and yet since July, before even QE3 was even really fully thought about, the Brazil against the dollar has been trading like 2 to 2.05. So 2%, 2.5% range is very small. So even if a trader gets it right and they're lucky to get half of the range, half of the move, they're still not going to make much money. But I think you see this across the board. Just at the end of last week, we saw the lowest volatility we've seen since the crisis began, both the euro and the yen. And so, on one hand, part of me wants to say that the lower volatility is like a spring coiling. And it coils, and then there's a big move out. You tend to get big moves when you have low volatility. And you get smaller moves when you get high volatility implied in the market. And so I suspect that we should be expecting some higher volatility, but so far it's just not coming. Despite the events, despite QE, despite the what Europe's doing and the deeper recession in Europe, there's just nothing that shakes us out of this low vol.
But maybe not despite QE, maybe because of QE. I mean, you talk about that coiled spring. It might have a very powerful restraint on that spring, is the fact that with the Fed taking so much tail risk out of the system through their purchases of assets, doesn't that reduce volatility? And if so, doesn't it mean that as long as the Fed remains in play in this regard, it'll keep volatility low?
Yeah, I think if it was just the Fed, maybe not. But I think you're right that it's not just the Fed, but you've got the ECB with their promise of this open market outright market
central
transactions.
Banks, we'll say.
Yeah. China, the Bank of England, they've been buying gilts, and they've been buying gilts at a percentage of GDP much more than the Fed has. If you look at the major central banks pursuing QE, the Fed has done really among the least over the past year relative to the size of the economy. So I think that all the central banks are moving to reduce tail risk. And I think the question becomes, many people say don't fight the Fed. And I don't think the market fought the Fed in Q3. I think the market went with the central banks in Q3. They reduced tail risk, so let's take more risk. Equities rallied, commodities rallied, the euro rallied. And I just wonder how much policymakers can control this. How much of it is them controlling it, and how much of it we say, well, policymakers can only do so far. So for example, how much will QE really help reduce the unemployment rate in the U.S.? Probably marginal at best. If anything, because we got the fiscal cliff coming, most people are looking for weaker growth next year than stronger growth.
Right. And if anything, the QE removes a tremendous amount of interest income from the economy. So that's income taken out. And there's really no transmission mechanism between QE and jobs. I mean, there's none. What's interesting to me, though,